Great. So I think everyone's here. I think we can kind of get started. So welcome everyone to the first Furucombo Radio. So my name's Josh. My alias is Blazar, and I'm happy here to be joined with some very special guests. So thanks to our guests for taking the time to join and be here today. And thanks to everyone else who's taken the time to be here today. It's going to be an exciting podcast. So all attendees are going to receive a OAT for joining as well, which will be claimable on the Project Galaxy website. And then we have also special NFTs from DeFiner, which we will be gifting to some random viewers. So we will be reaching out to some of you after the podcast. So make sure you have your DMs open and we can get a hold of you. So to kick things off, we'll just do like a brief introduction, so everyone listening can get an idea of kind of who you are, who the guests that we have here today are, and which project you're from. And then we can kind of delve into what you're building on Polygon. And then from there, we kind of have some interesting open-ended questions where anyone can kind of feel free to jump in and openly discuss some of these important topics for the crypto ecosystem and the Polygon ecosystem as a whole. So I'm on the Furucombo team as the community manager and working on the marketing side. So if you're not aware, Furucombo is a DeFi composability platform that allows like anyone to visualize combos using drag and drop GUI for creating like combinations. So such as using Aave to lend and borrow. You can maybe do some swaps and send those funds to a different wallet, and you can execute this all in one transaction. So that's our create mode. Another product we have is called Invest, which is akin to yield farming. So we work with Gelato on this to have auto compounded rewards on QuickSwap, on the QuickSwap pools, on Polygon. So definitely check that out if you're a yield farmer. That kind of allows you to not have to go in there and claim your rewards. It'll just be auto compounded back into the liquidity pool that you're providing on QuickSwap there. So, and then we're excited about our newest product, which we're releasing soon, which is our fund system. So this allows anyone to pool their funds with an expert or fund manager to manage their assets and allows them the highest yield possible, presumably while utilizing the composability of Furucombo. So if you're not an expert, using the create mode, you can provide your funds with someone else who is, and they'll maximize your return on investment using create mode on Furucombo. So join our Discord to follow up on that because it's going to be releasing very soon. So again, thanks to all our guests. I'll pass things over first to Devin from GYSR. If you'd like to introduce yourself and provide a quick brief on your project and what you're solving on the Polygon ecosystem.
Awesome. Thanks, Josh. And first off, thanks for having us on. Thanks everyone for listening. So my name's Devin. I'm one of the co-founders and a developer over at GYSR. What we do at GYSR is we're basically aiming to solve incentives. We think, broadly speaking, there's a pretty huge gap in reusable tooling across the crypto ecosystem. Reusable tooling allows for speed of development, it helps with safety, it helps for composability and interoperability between systems. And we're focused on the incentives and token distribution side of that tooling. So some example use cases, we're a zero code launchpad. A project could come on and set up a vesting system for their tokens, a liquidity mining system. They could use a single-sided pool for streaming governance rewards to their holders or their governing community. We've got some interesting integrations with Gelato actually for doing an off-the-shelf solution for Uniswap V3 liquidity mining. And we're constantly expanding to new mechanisms and new ways of rewarding users for particular action and really marrying the interests of the community and the users with that of the protocol. Excited to be here and chat more about everything going on Polygon and the broader ecosystem.
Awesome. Thanks, Devin. Next, we'll kick it off over to Chyna from DeFiner.
All right, awesome. Well, thank you for having us here. So my name is Chyna Q. I am the co-founder and COO of DeFiner. DeFiner, we are a decentralized lending protocol. It stands for Decentralized Finance Innovator, so DeFi with the NER. We started to build DeFiner ever since 2018. Back then was a wild west over there. The word DeFi didn't exist yet. Aave was still called Eastland. We started off with the pure peer-to-peer models. And then we have the pool model, which is the product you're seeing that we have live now. We're cross-chain. We just crossed over to Polygon. And right now we're building our next generation product, which is called DeFiner 2.0. It is a permissionless lending protocol. So what we're trying to do is capture the long tail assets. So the idea is like anybody can go on Uniswap and create a trading pair. Anybody can come to DeFiner and create a lending pool. So yeah, stay tuned to our communities, and we'll be talking more about our next generation product.
Awesome. Thanks, Chyna. Next, we'll go to Hilmar from Gelato.
Hey everyone, how's it going? Good to see some familiar faces in here. Hi Devin. Hi Nemo, what's up? So my name is Hilmar. I work at Gelato. Gelato is Web3's automation protocol. We help projects, developers, or literally everyone in Web3 to automate their smart contract executions. We have this fairly easy to use application where you go to app.gelato network and you can just sort of copy paste in a smart contract address. You can just select from all the functions that the smart contract has, and then you can define when you want to automate certain functions on there, and yeah, that's it basically. And then Gelato will take care of it and we'll just start executing your transactions for you. And yeah, we work together with awesome projects like Furucombo for the auto harvesting vaults, also GYSR and other interesting use cases are, for example, automatically petting Aavegotchis on the Polygon network every 8 hours so they don't feel lonely, or a lot of other stuff. So yeah, there's sheer endless opportunities you can do with it, and yeah, excited to be here and talk more about what's up on Polygon these days.
Sweet. Thanks, Hilmar. Next up, we got Captain Nemo from Tesseract.
Hey, gang. Hi, everyone. As Hilmar said, a lot of familiar faces. So yeah, I'm Nemo. I'm one of the guys in Tesseract project. What Tesseract is a friendly fork of Yearn Finance, or you can call it also younger brother of Yearn Finance. Basically, for the people that don't know, Yearn Finance is a yield aggregator that started on the mainnet and then grew to Phantom and now to Arbitrum. And then we are a younger brother that wants to focus to the other chains and try to grow the yield automations on different chains. Basically, the idea is like how the time is passing by, the building blocks of DeFi are more and more inclined to utilize the LP tokens, and we'll talk about that a bit further in the call. But basically, this is becoming one of the composable elements for any over collateralized platforms, or generally speaking, for anybody that wants to not think about the yields, just like to supply liquidity and forget.
Awesome. Perfect. Thanks very much, Nemo. And then last but not least, we have Aishwary from the Polygon team.
Hello everyone, and thank you so much for inviting me to this AMA. I basically work with the Polygon side in the DeFi world. I basically manage the operations, sometimes the business development, and as well as the marketing side for the Polygon DeFi. Very happy to be here, and more than happy to go ahead and answer any questions that the community has for the Polygon ecosystem.
Perfect. Thanks very much. So I think we'll just kind of open it up to the open-ended topics first, and then we can start a discussion around kind of these important topics, things that's going on in the ecosystem, maybe happening to Polygon or crypto ecosystem as a whole. So the first one we have is around liquidity provision. So how does liquidity affect your protocol, or negatively or positively? Does liquidity matter for your protocol? Should liquidity be incentivized? And then at what point does incentivizing liquidity have diminishing returns? So like in the industry right now, we're seeing a lot of like mercenary liquidity where you get a lot of liquidity initially because your rewards are very high. And then once things start to, once the rewards start to go down, kind of this mercenary liquidity starts to go elsewhere. So, you know, does this have to be prevented? Does there have to be like a locking mechanism or like a governance mechanism? So is liquidity important? And then how can, you know, is it important to manage the risk around mercenary liquidity? So, you know, feel free to jump in, anyone, if you want to discuss about this topic.
I can jump in quickly. I think over at GYSR, one of our most common use cases that projects use the platform for is definitely liquidity mining. I think it's a very natural and healthy thing to do at the beginning of a project. It's, you know, I think for any protocol, no matter how you're designing it, the end goal should certainly be scale and critical mass where things are self-sustaining. You know, trading fees should cover the incentives for an AMM. The, you know, lending fees should cover incentives for providing that collateral and lending to each other. You know, all of those things should get to a critical mass, but to kick off into Bootstrap, I think rewards and incentives that are going towards participants is a very healthy and positive way to get things moving and get that flywheel going. As far as avoiding some of the issues with mercenary liquidity, I can speak from our side. You know, some of the options and configurations we allow are focused on time incentives. So users that stake for some desired period of time earn extra reward, or you could enforce from the other side a vesting schedule where rewards are slashed if you want to stake too early or claim too early. And I think that's, you know, that kind of concept is healthy and, you know, helps to further align some of the things you can do with promoting things the right way. I'll throw out one other interesting thing that we've been working on is instead of streaming raw rewards, so this is a solution we have with UMA, you can actually stream a KPI option. So, you know, instead of just dumping rewards that can easily be turned around, that could be a different ERC20 token that's actually wrapped around some payout based on a metric on your ecosystem. So let's say you wanted to, you know, prioritize or target total number of integrations or TVL on your own platform. You could have those rewards only actually pay out in a meaningful way if things are doing well and if the overall community is promoting those incentives. So I think there are a lot of clever ways that you can do liquidity mining, but do it in a healthy way, is I guess ultimately what I'm getting at.
Yeah,
I can also.
Oh yeah, go ahead.
All right. Yeah, so I can also piggyback on that topic because coming from a DeFi lending protocol, liquidity is definitely a key to us. I mean, I feel like, you know, incentives is a very good way for protocol, you know, just to decentralize governance and also, you know, scale up. But like, I think in the current world, the incentive program has been abused a little bit. You see users hopping from protocols to protocols, programs to programs. But, you know, from a project perspective, it's very hard to build, you know, the customer loyalty in this way. You know, at DeFiner, we actually thought of a way, you know, just to end this endless cycle. So as I mentioned briefly earlier, we have the DeFiner 2.0. I briefly talked about the permissionless lending part, which is where, you know, anybody can create a pool. It's good to capture the long tail assets. But the second aspect to it is the configurabilities. So you can configure your own pools with factors like, you know, risk control model, loan to collateral, and most importantly is the time. So what we call this the DeFiner hodler market. So like users can deposit and their fund will be locked up for for a period of time. So this is actually, I think, is a very good way, you know, just to build up the royalties, the initial royalties of the customers. You know, once they're in for a period of time. It really will help projects, you know, to build their customer loyalty in this way.
Yeah, I can jump really quickly. So yeah, regarding the liquidity mining generally and regarding the mercenary liquidity. So I do believe that currently in our ecosystem, but mostly because it's really young ecosystem. And when I say ecosystem, I'm not talking about just Polygon. I'm just talking about the whole DeFi ecosystem. Definitely the more people are educated and know how to use bridges, know how to read contracts, know how to understand what's going on with the different protocols, they will more move from protocol to protocol. And I do expect that that type of behavior will continue from the user base, where people will try to get the best yields possible, especially how we are working on lowering the gas fees by using different chains and different scaling solutions. This will be easier and easier for the users. Now, what is cool on that side, and I think that that's not bad, is that it's pushing all of the builders to innovate as much as possible. Not just about the token economy or not just finding a way how to push the user to stick for as long as possible, but also to kind of like work on the innovation that is, as we all know, like a couple of projects already started working on something that is project-specific liquidity and protocol-owned liquidities. So that's like something really interesting that is going on in the space. But definitely, I believe that how the movement is happening and how the yields are changing, that's how the mercenary liquidity will move. Just a couple of, I would say like a month and a half ago, for us in Tesseract, it caught us off guard that some of the liquidity mining programs from the strategies that we were developing and using stopped. And therefore, some of the API started dropping for that particular period of time while we started working on the different strategies. And of course, what we saw is that how the time was passing by, people started just moving their liquidity to somewhere else. And I do believe that for the next, I guess, at least 2 years, we will see more and more of these things happening. But as I mentioned at the beginning, I do believe that with all of the new interesting development that is going on, not just with protocol liquidity, but also, for example, Yearn started, well, one of the co-writers of the ERC standard, ERC 4626, which is kind of the standardization around interest-bearing tokens, is also Yearn team. And I do believe how the time is passing by and how we implement some of these standardizations and how we implement different mechanics, we'll see more and more sticky type of the liquidities. But yeah, as I said, like we're in the beginning, and I feel that definitely we need more to work on the innovation in order to see sticky liquidity happening.
Yeah, perfect. Yeah, I mean, do you guys feel like liquidity is a good measurement of success? Because I know a lot of people, they jump over to DeFi Llama, they look at which protocols have the most liquidity, and kind of those are the ones they're looking at first. Is that fair, or, are there other metrics that people should be looking at?
Well, I will add there, that of course that I expect that anybody, any protocol that is doing something around liquidity in general, whether that's a decentralized exchange, insurance, or anybody else that is doing some money markets on the DeFi, in the DeFi space, definitely one of the measurements are the TVLs. But also like the TVL don't need to mean anything, in my opinion, because as we are aware, numerous times what was happening is because high API, people went to some chain for like a week or 2 weeks. The liquidity grows like tremendously, like 100, 200%. And then immediately when either people start dumping those tokens and kind of like wrecking the whole protocol, or there is security exploit. And a lot of times people do like bad copy pastas and just like deploy protocol that is copy of something on the different chain. The security is also one of the big issues. And I think that people are not paying attention that much when they're just deciding to ape into the new protocol that is developed by somebody. So accept the TVL. I definitely believe that one of the important things are what is the mechanic that these people are building, how interesting and how innovative and how strong they feel about this team. But then again, I think that the challenge that we have there is that not that many people know how to read smart contracts, not that many people feel comfortable with understanding, but ape immediately. And as long as we're having that, we will have like a lot of challenges that we are seeing with the exploits.
I think an interesting way to look at that question around TVL as a metric with respect to incentivized programs is kind of the same way we look at, like everyone knows to look at market cap versus fully diluted market cap. If you look at TVL and then you look at like the percentage yield coming from the native protocol fees that will be sustainable versus the temporary incentivized like, yield farming, liquidity mining, whatever it is, you kind of have like some ratio that you could deduct against the actual TVL. And that's almost a more meaningful metric on protocol health.
Yeah, maybe just to add my 2 cents to that, like from a network perspective, such as Polygon, for example, let's say comparing it to Ethereum or other networks, I think, so the bare bones metric is always sort of demand for block space. So how many people actually want to interact with the network at any given moment in time, of course, over a sustainable period of time. The more that do, that kind of corresponds to organic demand and actual traction for the kind of like base layer protocol. And you see that if really like crazy spikes can happen during certain periods there, you always know, okay, there's real demand going on. And then I think a proxy for that is volume on exchanges, so decentralized exchanges, because volume, let's say like TVL doesn't really mean much. If you look at, for example, Curve, for example, they have a huge TVL, but I think like volume wise, they're still like significantly lower than like a Uniswap V3, for example. It is from a TVL perspective significantly less, but it's actually really used and integrated in a lot of other DeFi protocols to liquidate collateral or for just trading to happen, because it is sort of like the most efficient or one of the most efficient AMMs out there. So I think this is sort of like a proxy for usage for protocols more than just base liquidity, which can just remain there for like a day or two and then move on to somewhere else. And also regarding the liquidity provision side that we discussed just a moment ago, I think liquidity mining sort of like not the issue. It's actually, and mercenary liquidity is also not an issue. I think this is just completely normal. It's incentives, right? You like if there's a given financial incentive that people can abuse, they will abuse it. So I think the systems just need to be built in a more robust fashion. And like for me, the solution is hedging there. Like right now, the LP opportunities that projects provide their community with is just ludicrous. They are always like, market making is usually a loss making strategy. And if you talk to centralized market makers, this is usually what happens, right? So what you have to do in the real world is you have to pay market makers, and they either you've paid like a flat fees to compensate for the losses, or you actually provide them with certain options so they can hedge their exposures, because they've got certain inventory risk for holding your assets. They need to buy your asset when it goes down, for example. I think we will see like a next generation of liquidity protocols or layers that will focus on hedging these sort of strategies that will enable LPs to earn significantly more long-term robust rewards, and have the payment from the protocols go directly to sort of like derivative protocols that then provide these options, rather than just like spraying their own token across a lot of LPs to then compensate for their losses due to impermanent loss, for example. So I think this is sort of like, I think, where we will move towards eventually, because this is how it works in traditional markets. Usually it's just that like derivatives and hedging is just very early still in DeFi. But yeah, this is just my take on it.
Yeah, that's a really good point. I just wanted to kind of hear, hate to throw you on the spot, Aishwary, but just from a like a protocol perspective, do you guys look at liquidity? I know you guys, from what I understand, you look mostly at kind of user growth. Is liquidity kind of in your consideration, or it's not really a worry for at the protocol level?
Got it. So let me explain to you a little bit in a different context. Let me connect it to Web 2 as well. And I'll ask a question from you. Like the question is, let's say in your fintech world, forget about blockchain and Web 3. In your fintech world, what exactly is the application today that you tend to use? If, let's say, for example, for payments, you have 5 different applications, what exactly is your choice? Like, what exactly are the things that make you choose that? So I think one of the, like, to make it a little bit clear, it would be more like the app which you are more addicted to, the app which is more user friendly. I mean, is there any third point that you see right now? Like, anyone can answer this.
I would say the one with like the least fees.
I only use crypto. Sorry, I can't answer this.
So, one of the things that Web2 has taught me over the past is how much you are able to make the user grow fonder of your application. That is something that gives a very big advantage or a very big roadway for your mass adoption. Now, in order to do that, this is something like liquidity mining is not something which is Web3 centric. So what happens when these apps come in? They give you free vouchers, they give you free use cases, they give you discounted. Let's say in India, I think most of the discounts are there in India. If you order food from one app, you get 40% discount or something like that. So that is exactly what liquidity mining is all about. It is basically incentivizing users to go out and try a product, to enjoy a product, and to tell the whole ecosystem that this is something what I love. And that is why, like this time when we talked about liquidity mining, we did not go ahead and we did not say, hey, we wanted to go ahead and do liquidity mining based on like selected few apps. We said let the users decide. So if the users are happy with the protocol, they will have more weekly active users. A dApp will have more weekly active users, and also there will be more TVL committed to it, because more and more users are actually going to go out and put the TVL there. So this is like one way in which that fair liquidity mining rewards are being given out. And along with that, what you also get is more and more acceptability in the whole ecosystem. So that is what liquidity mining according to me is. So that is why, I mean, liquidity mining or maybe some other ways, I think last year when liquidity mining was not even a thing, I think Polygon started it. We started with Aave, gave them like 1% of the supply for liquidity mining. Now, if you see today on Polygon also, even when all the rewards have withdrawn, the mercenary capital has gone, but the number of users that are still using Aave is still at a pretty decent state. The reason is, or what we can say from that is, we were successful in driving people towards Aave, to use Aave, and to ensure that they like that platform. Now, until and unless there's a very big innovation where you're able to save a lot of money and something like that, you will still want to go and stick with Aave. Yeah, there are like so if it is very considerable differences, like then you will switch to different things. But if it is a small considerable small difference, you will always want to go out and you would always want to ensure that yeah, I can still stick to Aave. Maybe there is another protocol giving 1-2% or 3% more, but I'm fine with it because I'm used to Aave. So that is what this whole Web3, if you compare with Web2, this is where these rewards come in. So telling them whether they're right or wrong, I mean, that's how the whole world is working. It worked in Web1, it worked in Web2, and the same way it is working in Web3, where user adoption through these things are happening.
Yeah, that's an interesting perspective for sure. Thanks for that. Yeah, so just kind of touching base on the kind of, like what we've seen with Uniswap. There's good efficiency there. There's good brand awareness. People like the protocol. So even if there isn't crazy incentives, there's still a certain amount of liquidity that will stay. And then I think another interesting factor that Hilmar talked about was the volume. From the volume, you're generating a lot of trading fees. And then even without incentives, it still could be worth it, or there's a good amount of kind of incentive enough to stay there and support your protocol, which you're safe on, right? Uniswap's probably one of the most vetted DeFi protocols. It's very unlikely that you're going to have a security risk there. So from a big player, they're going to be more inclined to provide their funds there, as opposed to somewhere else that may have higher rewards, but a larger security risk. So all interesting points for sure. Does anyone have any kind of ending comments on liquidity provisions?
I think one other thing to mention as just an emerging pattern in different class of, we're talking mostly about like renting liquidity, these temporary incentives, bootstrapping, getting a promotion going, and hoping people stay. There's a lot of new interesting work going on in more permanent provision by a protocol through bond sales and similar mechanisms, token auctions, whatever it might be. And this is another totally, similar goals, but different approach. different set of tools. And I think it'll be interesting to watch and see how those, how sticky that ends up being and how permanent of an approach and strategy that ends up being compared to more traditional liquidity mining.
For sure. Another good point. Yeah. I mean, just got to see how things go, and things are evolving. Like was said, it's, it's all still pretty new, still pretty early. We've only kind of been doing this for, maybe just under a year and a half. So we'll see how things evolve. So cool. Yeah. Thanks everyone for your ideas and thoughts on the liquidity provisions. The next open-ended question we'll go to is kind of how do stablecoins play into maybe a chain's or a protocol's success? So we've seen some algorithmic stablecoins kind of pop up recently. Terra Luna's making a big push for UST. They're providing, a lot of incentives on a lot of different platforms. They're trying to get their coin out there. Do these stablecoins provide network stability? Is there a use case for them when networks are tied to it? So, for example, I believe the Polygon team's working on the MyMatic stablecoin. So, you're going to lock Matic tokens, and then you'll be able to borrow from that collateral in the stablecoin. So, is this kind of the future where things are going with this algorithmic stablecoins, or what are your guys' thoughts on that?
I mean, I can take this question. So, when we talk about algorithmic stable coins, there are a lot of coins today, actually, when we talk about algorithmic ones. And what we have to see is like creating a perfect peg, which is like sometimes. So, I still remember Iron Finance. I don't know if everyone still remembers it, but I still remember Iron Finance that they were like the biggest ones going out and saying, hey, we are going to go out and be the best algorithmic coin there is. And I remember because I wrote a thread about it. But yeah, the point is that there are a lot of thoughts that you have to put in, and when you actually go out and create a stable coin out there, which is like more of an algorithmic one, the reason is because we want to ensure, or we want to go ahead and see that these algorithms, these pegs which are there, they cannot be exploited. Now if they cannot, if there are ways in which they can be exploited, what will happen is ultimately there will be someone, because there are a lot of people with great minds, giga brains, I would say, who will find out the ways in which this can be eroded. And the biggest problem comes in here is like everything is open source, everything can be seen, so people can go out and check the codes and everything, and they can figure it out. Earlier it was difficult to go out and figure out the codes because they used to be like in closed doors, but open source makes it even difficult sometimes. So that's something where stable coins, algorithmic one, are something which have to be very well researched. And that is where what is happening is like slowly and steadily we are going ahead and we are trying to find out what exactly or where exactly would that fit in. So there are a lot of stable coins and new coins also, I would say, which are in the making. Probably would launch on Polygon soon. Cannot name them yet, but yeah, there are a lot of researches going on. We have a lot of big giga brains working on it to ensure that all these things, whenever they are live, they are live with in a way where all these things are sustainable. They do not go out and they do not become unsustainable after a small period of time or after attracting a lot of value in it. Because the problem with that is like today everyone fears that what if USDT goes for like false, or is that there's a bank run, what will happen to the crypto industry. So that kind of a threat has to be prevented, and people have to ensure that everyone who is out there, they're able to go out and they're able to be there, and they're able to get this peg right. Once that is right, I think we'll have a lot of stable coins and everything working on and moving here in the ecosystem.
I also, just to add there, like I also think one of the interesting things that will potentially continue happening is with launching all of these different mechanics around stable coins, what we can envision in a couple of years is basically that we'll figure out that we can make more and more pools that is not just USDC, USDT, DAI, that is kind of like the most usual one. But now with, for example, Frax, what Frax is doing, and a couple of others that are doing right now, I definitely believe that how the time is passing by, we'll have stronger and stronger ecosystem of the stable coins. And it will matter, mechanics will be matter, it will matter what are the collaterals underneath that. I definitely believe that we'll see more and more collateralization around LP tokens. As you know, like for example, with Yearn Finance, or in the case of Tesseract, it's the same kind of thing where any of our vaults is a tokenized representation of your assets that are deposited there. And all of these assets can be used in a different protocols as a collateral, so you can mint other tokens there. So that is something interesting, that how the ecosystem is growing. We will see more and more of these things, and I definitely believe that this will make the ecosystem in Polygon, and then in the crypto general, will make it much more stronger. So that is something interesting to pay attention to.
Yeah, one thing maybe worth to mention is that at the end of the day, stablecoins is just about trust, and it's just about the brand that it has. Because the problem is just that if people lose trust, like what you're selling here is trust, and if people are losing it, then they will sell your token, and if they sell your token, your peg will be diminished. And even if you have an algorithmic stablecoin, if people just will continue to sell it, and not only because they fear it will go to zero, but because they are not real believers in the stability of it in the first place, and then they might only have hold it for like a given period of time because there were some nice incentives on it, right? You always have to ask yourself, if there's like zero APY on any of these tokens, which ones would I actually hold? And like, which ones would I personally hold as an individual, and which ones would which with all my wealth, which is, for example, not in ETH or Matic or any other token you might be bullish on, but for example, also for us, which tokens do we want to hold as stables for our salary payments for our company, right? So everyone is getting paid in crypto. Which stable coin do I feel comfortable holding on my balance sheet for 4 years straight, right? And I do also have to be super honestly, like I'm a big MakerDAO fan, and have been since the day one, but I also, like, there was this period where they had this sort of vulnerability in the oracles where transactions didn't get propagated correctly and stuff. And there was also a period where I felt a bit uncomfortable to hold DAI, for example, and I swapped a lot of my stable coins to USDC, because I thought, okay, I do not trust this. This system is still not as reliable for me as I wish it to be in order to entrust it with all my money or my company's money, right? So at the end of the day, you have to sell trust. You have to establish it. Like, these yield forming opportunities are nice to bootstrap liquidity, but projects, I don't know, like Abracadabra or whatever are seeing it right now as sort of like these yields drop over time. It will become harder and harder for you to actually incentivize more people to acquire the stablecoin or secondary market in order to actually push the peg up to be at that $1. And so, yeah, this is sort of like what you have to be and what you have to get at. And yeah, so algorithmic stablecoins versus collateral ones, I think it will be sort of like a mix. I like Frax approach, for example. They're collateral based stablecoins, of course, have like a debt ceiling always. There's only so much you can issue against so much debt, and all the debt is sort of like crypto native, right? So if crypto doesn't increase in dollar value, then we won't be able to expand more the stablecoin supply. That's why there are a lot of people talking about bringing in collateral from the real world, like houses or real bonds and stuff, to grow it further. But then, like, algorithmic ones are sort of probably the way to scale it. But yeah, still also quite new. And I personally wouldn't put all my money in them right now. I think you probably need to diversify. But yeah, it's up to everyone's risk appetite, I assume.
To add one thing that Hilmar mentioned that he reminded me right now is I 100% agree with him when it comes to the trust and when it comes to time. Like, I still remember last year in one moment when one of the founders behind the Frax started developing Frax, and in Lobster DAO, for those that don't know, Lobster DAO is one of the biggest DeFi chats right now on Telegram. And I would still remember that people were giving him so much shit about his ideas, design, and whatnot, and people fighting. either by not understanding or feeling that it's something that is not tested out yet and whatnot. And it really needed like a long time for people to become Frax believers, or whatever you would call, like people being comfortable with depositing a bigger liquidity in Frax, with mixing the Frax in the different protocols and whatnot. And yeah, like, because as I mentioned, like, industry is so young. We have so many still things to prove. We have like a lot of things that we need to help people not just understand, but build the trust. And the trust is built not just by the words, the trust is built also by the quality of what your work is. And that means also quality of code, but also means the quality of the way how you make the whole system work and how you make this all of the composability things in DeFi work between each other.
Yeah, that's a really good point. I don't think you can kind of beat the time in the market. As time progresses, everyone will become more comfortable with utilizing these different coins. You just kind of gotta wait for things to happen. From a lending protocol perspective, Chyna, is there any risk with these kind of, adding these algorithmic stable coins and potentially depegging from like a lending perspective?
Yeah, I mean, from a lending protocol, right now, if you look at the major lending protocol, they we only support like mainstream assets like USDTs, USDCs, things like that. But for us, from our DeFiner 2.0 perspective, we actually have a mechanism to control this risk. So it's actually the configurable pool, so anybody can come and create a pool. So the risks are actually up to the users. Like if you're more risk averted, or you like risk better, so you can create different lending pool for different assets or stable coins. So it actually have more flexibilities to it.
I see. Perfect. That sounds great. Okay, so we'll wrap this one up unless anyone has any closing comments on stable coins. Cool. So I think we only have time for maybe one more open-ended question, and then we'll just have some closing comments about the Polygon ecosystem. So the next one I want to go to is how do you guys stay relevant in a multi-chain world? There's so many networks now, EVM networks, and networks that aren't EVM as well that are kind of popping up. People are scattered around, up to 50 networks now. So how do you ensure that your protocol is moving to the right networks, ensuring that you're capturing as much user base as possible, and that you're making the right moves in this ecosystem? And, towards Polygon, how are you guys ensuring that you're not kind of falling behind these other networks?
Yeah, maybe I can take the start here. So, I think like what I just maybe from a personal perspective, what I personally made the mistake a lot of times at the very beginning, and one always kind of gets comfortable with what is currently the status quo, and then oftentimes find themselves in a situation where they disregard new things popping up that might initially look like only incremental improvements or just bad takes of what has already been done. But I think what's important to note is that what for me, what like crypto and blockchain, especially like the open source movement in general, is all about is like these different, very fringe, exotic communities, assets, networks, basically communities that can just emerge out of people taking existing code bases, applying them somewhere else, focusing on different sort of problem sets, and then kind of trying to build up their own communities. And for me, like ETHLand back then, or Aave right now, is a good example, right? So the concept when they switched over from peer-to-peer lending to protocol to borrow lending was very similar to what Compound did before, right? But how they differentiated themselves at the very beginning was that they really focused on these exotic assets, right? Back then Tether was a really, really exotic asset, right? So no one listed Tether, and they were the first one to list it. It really went quite big, and then they invested, like they slowly onboarded nowadays the blue chip stocks or the blue chip tokens, but back then they were also very exotic, right? And they quickly onboarded them, and they were much more free in onboarding them. And this sort of notion led to their success, because these communities can grow into their own ones, and they can really start to thrive. And a lot of them will die. I think like probably 90% of the chains that are built up and are raising a lot of money, industry money, will probably die over the next month or years, but new ones will rise up from the ashes. And I don't see it as this sort of like suddenly one thing and then that's there. It's just this evolution of things starting to fall and rise and fall and rise. And you just have to be, I think, open-minded. You have to be flexible. Of course, you have to prioritize based on certain metrics where you want to go. But for me right now, we are in this multi-chain world, and we will live in this multi-chain world. And all of the applications using Gelato are building in the multi-chain world, and Polygon is part of it, Ethereum is part of it, right? And this is just the status quo right now, and I don't think it will go away in the foreseeable future. And you have to embrace it, in my opinion, and just appreciate all the different communities and what they're doing, and try to of course place your bets appropriately, but don't kind of fall into the dilemma of not giving something new a chance, which it oftentimes deserves. They are genuine people building genuine stuff, and also often good teams building stuff. So I would always give everyone the opportunity they deserve, and see what's all about and try it out at least.
Yeah, I think that definitely completely agree with that. It's so easy to get pulled into complacency and have a working system and feel good where you are. I think a lot of that risk appetite is something that at the project level, teams need to really assess the risk versus upside of deployments to new chains. Depending on the project, there's a huge range of the workload and the long-term implications for multi-chain deployments. It could be, for certain projects, it might literally be, an afternoon of deploying contracts, setting up configurations, and it's all self-serve after that. For other projects, there's a lot more hands-on maintenance that needs to go into every single chain across biz dev, subgraphs, external infrastructure, things like that. So I think every project needs to look at opportunities they've missed, opportunities they've been successful on taking advantage of, and get a good gauge on how they should assess their own strategy. Because there's a huge range of projects like Sushi that deploy everywhere versus projects more like Uniswap that take a very cautious approach towards each new chain deployment. So it's a matter of, I think, project fit with different strategies there.
Right, I totally agree to that. I think, the key is not to chase the hype. I mean, there are just so many chains that out there. Different chain has different users, from a project perspective, the key is just to really evaluate what's the best for the projects, what's the best for the community, and then really do the evaluations before deploying that. Of course, different chains has different ecosystems that fits into different situations. From a DeFiner perspective, we actually just launched the multi-chain initiative. The reason that we choose Polygon is because of all the good projects, the quality projects on Polygon, and also the ecosystem as a whole. For our perspective, not only do we look at volumes and transactions, TVLs, and things like that. I think community and ecosystems is the crucial key to us too.
Yeah, let me add on that. So you can always just fork a project, put a token, and launch different token on different chain, and just with that grow the liquidity. Of course, I'm joking here, but to come back to the question regarding the liquidity and the growth of the ecosystem, how you choose, I can share a couple of important things that we and the Tesseract are looking for, and that what we learned from Year in Finance in that manner. So one of the things, when you're choosing a new chain, at least for us as a yield aggregator, the most important things are what are the building blocks that are there. And I think also for the health of any chain, the most important part are building blocks. If you're talking about DeFi, one thing is to have decentralized exchange. Usually those are either forks of Uniswap or just forks of Uniswap, or you have a forks of Curve. Those are like two most kind of like forked decentralized exchanges. Then you have like lending borrowings that are usually fork of Compound, fork of Aave, Banqui, which is kind of like a fork of Compound, or like the things like that. And you usually need these elements in order to start building the ecosystem. Now, also what is important is a lot of times people are approaching us and saying, oh, but look at this amazing project. It has like 100% API on the stable coins. But the fact that people are like missing out there is that when a protocol such as a yield aggregator, such as Tesseract, tries to deploy the strategy, if the pool is not big enough for that particular liquidity farming, let's say that there is like a new project, random coin, and they have like a stable coin pool with 5 million liquidity in there and 100% API, you need to realize that a moment that you deploy the strategy and the moment that there is like 5 million more there, the 100% API is gone. So important parts are like, in my opinion, the depth of liquidity, the composability of the different Lego building blocks. And one of the things that I can say, and I'm a bit biased because before Tesseract, I was helping out a lot Polygon DeFi team, is that it's important really from the early stage of the blockchain protocol, infrastructure protocols that are trying to build ecosystem, it's really super important to focus on these building blocks. Because if you don't build these building blocks, it's really hard to push people to come there. So yeah, those are my two thoughts.
Yeah, just to speak from like the Furucombo perspective, ours is kind of interesting because we have to focus on networks that are kind of already established instead of like coming in at the cutting edge, the beginning of things. Since we're aggregating other protocols, we kind of want to look at ones that have multiple protocols. You can utilize multiple strategies, and then have long-term initiatives or goals. We believe when we move to Polygon that they're going to be around for a long time. So that's why the Polygon network was our first choice. And then kind of looking at maybe blue chip protocols, like where is Uniswap launching? If we integrate Uniswap on Ethereum, it's much easier to integrate it on other EVM chains. So if we can target maybe 4 or 5 blue chip protocols, and then those are all launching on the same chains, that makes it much easier for us to kind of follow where they're going and launch on those networks as well. So I think we can close up that unless anyone has any closing comments on how to stay relevant in the multi-chain world. Cool. So quickly here, we'll just get one question in around the Polygon networks. So Polygon's going to have a bunch of sub-networks, Nightfall, Maiden, Zero, Hermes. Will developers easily be able to port to these subchains? And then how are you guys going to aggregate all these different protocols? Are there going to be liquidity on these different chains? Like, how is that going to work?
I think what we are aiming at is ensuring that any kind of build that we want to have, like there are various protocols, there are various enterprises, there are various Web2 companies, there are various kinds of games and everything which is there. So one solution cannot fit everything. There are different requirements, there are different needs based on which various solutions can actually go ahead and can actually like be there. So that is what Polygon is working on. So various solutions which are there. Obviously, the whatever chains we are building, like for example, Polygon Edge, which is like where a lot of dApps, which are the major dApps, they've already started building and would be deploying very soon. The point basically is because they have a separate requirement, and here what we wanted to do was we wanted to just cater to the requirements that these big dApps had. So similarly, other chains also. So every chain which or every solution that is launching on Polygon has its own use cases. They're not like every use case is not for every single dApp. Every dApp could there are various use cases, and based on what your dApp needs, you can pick up any solution which is built, which is most suiting your dApp. So that is there. That being said, there would be no like issue with the liquidity, because there are ways in which we have already thought about it and tackled it, that the fragmentation of liquidity does not happen, whereby we get more efficiency, lesser cost, and more composability, and a way in which you can like design your own chain. So that is where we are heading towards, a solution where everyone has its own choices to pick up what kind of a solution they want to need or use based on whatever their requirements are. So that is what we are doing here.
Awesome. Sounds great. Can't wait to see some of those chains go live. I believe which is the furthest along, or which network's kind of going to be going live first?
I think Edge is going live. It's very near to its live thing. Then I think Nightfall is also going live after that. And then after we'll have Hermes, then we'll have Maiden and Zero going live.
Perfect. Just some Polygon alpha leaks for everyone. Well, great. I think that's pretty close to an hour there. I don't want to keep anyone any longer than that. If anyone has any closing remarks on anything, otherwise, that's a great place to stop it, I think.
Perfect. Thanks a lot for organizing this.
Yeah, you bet.
Thanks so much. It's been a great discussion.
Yeah, I have one small shell for everybody. So anybody here who is a developer and working on the smart contracts and is coming to Amsterdam, Yearn together with Tenderly is organizing a war room simulation. That's something that I definitely encourage anybody who is building in a blockchain to go, because once you have the war room situation, and we could usually call war room situation is when assets or any security exploits can happen on the protocol. Of course, it's not something that you dream of or that you like to have, but definitely I encourage anybody who would like to learn a bit more and be part of these simulations and trying to kind of like mitigate the risk on that session, go to Yearn Twitter and check the last post and apply to waiting list. So yeah.
Awesome. So yeah, thanks again, everyone, for coming. There will be OATs for everyone, and DeFiner will be providing some NFTs for some random listeners. So definitely have your DMs open. So thanks to Hilmar from Gelato, Devin from GYSR, Aishwary from Polygon, Captain Nemo from Tesseract, and Chyna from DeFiner. Appreciate you guys coming, and hope you enjoyed the podcast. See you at the next one.
Thank you for having us.
Thank you.
Thanks, everyone.